We need to talk about tomorrow's critical CPI read. Oh man, within 24 hours, we will receive our first 2023 CPI read. Yes, on Valentine's Day tomorrow at 8:30 Eastern Time, we will be getting our CPI reading, and this is expected to shake up markets. In this video, I'm going to break down the expectations, what is likely to happen, how are we going to play it, and more importantly, what is being priced into this market. First of all, shout out to the old Binance. They're struggling with the SEC, so I thought I'd put this hat on in solidarity with them. If you not watched my video from earlier today covering off the BUSD banning, make sure you go watch that one. This is the CPI video. Let's break down exactly what are the expectations. First and foremost, we'll start off with the headline year-over-year figure that is expected to come in at 6.2%. This previously came in at 6.5, having dropped 0.6 versus the previous month. So the growth is starting to decline, and that's the overall trend of what is being expected in tomorrow's meeting. People are expecting inflation to have a bumpy ride, not this smooth reduction we've seen over the last few months. We're going to get into the reasons why that could be. So 6.2% the market is expecting on the year over year. For the month over month figure, first we have to notice that there's been a very important revision, and this is very important, guys. Sometimes this stuff gets swept under the rug and nobody pays attention. When we covered off the December release, this was given as minus 0.1 month over month. In fact, it's deflationary, right? Now they've since revised that by 0.2, so it's now positive 0.1. So this is a significant move. I know it doesn't look like a lot because you're dealing with small numbers, but a month on month 0.1 shows a 1.2% annual inflation rate versus the negative version, which would have been a deflationary 1.2% annually. So it's a 2.4% swing in the inflation figure. That's very, very important for us to understand. So that's been revised. Now this is expected to come in at 0.5% month over month. Now again, doesn't sound crazy, but it's the highest figure since October, and before then you'd have to go all the way back here into June of 2022. So this is a significant little ramp up here, given that we thought we would start bringing month over month figures to the downside. The core inflation figure is expected to come from 5.7 down to 5.5. Again, not as steep as the declines we've seen previously. So they're showing that it's, creating a little bit of stubborn inflation, and that's the narrative that the markets will be worried about. Remember, markets are concerned about this narrative of there being real entrenched, stubborn inflation in the economy. Right now, we're seeing inflation come down, but there's no guarantee as to whether 4%, 5% of that inflation right there, stuck in there, could be entrenched, sticky, which could take a very long time to come down. And that is what markets will be focused on. If you've made it this far into the video and you someday want to be able to read the markets, do technical analysis, trade as we are doing on this channel, then perhaps you may want to check out my free technical analysis from scratch course over on SKILLSHARE. For those who aren't familiar, SKILLSHARE is an online education platform. You sign up for a nominal amount each month and you get access to a wide variety of different courses. I personally use it to learn all sorts of things, from video editing to financial to using Excel and various other bits and pieces that you may want to learn. It's far better than YouTube on those elements, because on YouTube everything is about retention, whereas with a course you can put things in a structured curriculum, and that is exactly what I've done with my TA course. It's completely free for the first 30 days. If you click the link in the description, ijaz.uk/TA, to take advantage of the TA course. Let me know what you think about it, and let's get back into this video. So we will be looking for this core inflation year-on-year figure to come in at 5.5 and the month over month at 0.4%. Now, therefore, what happens if these do not come in at expectations? Well, we need to take a look at the Fed rate monitor to get a clue. Now, currently, you can see that the Fed have kind of been a little bit clear. We kind of expect what the Fed's going to do. And the markets have priced in that we're going to see 25 basis points again in the March meeting. You can see 90% of the market has priced this in. We're then expecting at the May meeting, the majority of the market is pricing in another 25 basis points. Okay, so that gets you Fed funds rate from 5 to 5.25. And then in the June meeting, which is the third meeting from now, is where markets start to get a little bit split between whether we're going to see a pause. So half the market's expecting a pause at that point. Now, of course, there's a whole bunch of data which is going to come out between now and then, which will skew these pricing in factors as we get those data releases. Now, here's the thing. We've been seeing a positive trend here on core good inflation really coming down. In fact, over the last few months here, we've even been seeing some deflationary aspects, some disinflation aspects here on the core good elements. What the worry, however, is the core services, this purple line here, and this being stubbornly high. Now, what's further reiterating this concern is the strong labour market report we just had. We've seen that unemployment is still at its lowest level since 1969, and wage inflation is still around. This is causing concern amongst investors that core services could still be stubborn. Maybe the Fed have done a good job on bringing core goods down through the interest rate hikes, but what about the core services? This purple line here, what if this remains stubborn and doesn't come to the downside? Now, there has been a change to some of the weightings. They've announced that they will change the methodology around used cars and also how they're going to change the weightings annually now going forward. And that takes effect first from this meeting here. We also notice that the CPI weightings are heavily skewed towards owner's equivalent rent. So we need to keep an eye on this because we are seeing indicators in the housing market that it is starting to slow down, but due to lags and base effects, we don't know exactly statistically when this will feed through to the CPI reading. For example, if you head over to Redfin, you can see clearly here that house prices really have started to trend down. You've seen that here month over month. We have been seeing a decline over the last 6 or so months here, both on the median sale price, the number of homes sold are down 36% year over year. Okay, so we are seeing that the data is suggesting shelter and house prices, which is a big weighting of CPI, should be coming down to this downside. Now, we've also been seeing easing in energy and food costs, and the price of used cars have also been falling. But one thing we have noticed, which is important to bring to your attention, is that crude prices have started to become a little bit stubborn. And again, this fits the narrative of what we're scared about. Look at how the crude price was falling dramatically here, all the way down here into November time. And then we've been sideways. In fact, if I pop this down to the 3-month chart, look at this. We've pretty much been sideways here on the crude prices, and this is showing that it's being stubborn. It's not falling anymore like it was. If we go back to the yearly chart, look how it was coming down, and then it just moved sideways for a little bit here on the WTI crude price. That's something for us to watch as well. Here's where things get interesting, because the reality is, when we covered off the last CPI reading, the market did not price in any room for error. In this case, it's been the opposite. The market has priced in the complete bear case. They've priced in that inflation's not going to come in that badly. So if we do not get a meet today, it could be quite painful. If we do not get the meet on that CPI reading, we will see pain in the market. And in fact, if we get anything worse than that 6.2%, if we get anything worse than the 5.5% on core, we could be seeing a very painful market from tomorrow. But then what's the other side of the sword? Well, the other side explains that, hang on, if we've not priced in any positive case and then CPI beats, if we get 6% inflation, 6.1%, 5.9% headline inflation, if we get a good cooling off for CPI versus the expectations there, markets can actually rally because it's not being priced in. That's very, very important. I see a lot of people look at the figures versus the expectations and assume we're going to get a rally or we're going to get a huge dump. It's all based on what is being expected. So in this case, markets are saying we're expecting 6.2%. We're expecting inflation to come in fairly hot. So if it does, then markets aren't going to be too shocked. They expected that. But if it misses, if it comes in at 6.3, 6.4, expect Bitcoin to struggle here. Expect us to come and test 20,700 because that's our next level of support. If we lose the support where we're hanging around here from this level here at 21,700, we will be falling to 20,700. That's our next level of support. And even worse, where's our support after that? We really do start free falling. We've got a little bit at 18,800. Which, by the way, if we go to our other diagram here, you will see is the top of our channel. 18,700 right here is the top of our channel. But other than that, we've not got much support, okay? So we're looking at this cluster here to provide some support. Then we've got 20,000, which is a psychological level. And then you've got 18,800. That is the downside. Now, what's the positive news? If we get a beat on inflation, 6.1%, 6%, we see a positive news tomorrow, we could really see a positive day because the markets are not expecting that. And that could not only secure this level, but maybe we can get a move up to 24,000. Now, of course, it's not just about wider markets. We know crypto over the last 24, 48 hours have been having their own issues. We covered that off in the video earlier with Kraken's $30 million fine. You've had BUSD now being banned. The SEC and US regulators are going after crypto, and naturally, that's going to have effect on markets. You're seeing Bitcoin slightly down today. You're seeing a lot of altcoins tumble to the downside. But we need to look at it from a wider market point of view. And the wider market point of view wants to see inflation continue to come into the downside. And if we see that, especially when the market has not priced that in, we could expect a nice move to the upside. So there you have it, guys. Those are the expectations on CPI. Let's just type this up so you guys can screenshot this as well for your own purposes. Headline inflation year over year. We expecting 6.2%. For month over month, we expecting 0.5%. For core, we expecting year over year at 5.5%, and we're expecting month over month at 0.4%. If we see these figures hit, at least we need a meet. If we miss this, we could get a lot of pain in the market, guys. I just want to make sure we understand that. But if we get a beat, the market's not priced in a beat. So if we get some good inflation figures coming down meaningfully, that could set us the green lights to get a nice move in the markets. Now, another reason this CPI reading is so important right now is the position that the dollar index finds itself in. Remember, the dollar index is typically inversely correlated to the crypto markets, and we need this to remain in a downtrend. You can see that the dollar index has come up to test its EMA ribbon, and it spent the last 4 or 5 days here trying to break this EMA ribbon to the upside and reclaim it in a bullish sense. Now, if the CPI reading comes in too hot, expect the dollar index here to start climbing above 103, 104 level and closing above its EMA ribbon. We want the opposite. We want CPI to at least be a meet, in which case the dollar index will hang around here, or we get a nice cooling off of CPI inflation and we can start sending the dollar index back down here on its downtrend and reject it from its EMA. It's a critical CPI reading, the first one for 2023. Markets are pricing in a Fed funds rate currently of 5 to 5.25%. So they're expecting this to get to that 5.25% by the end of May and then keep rates there pretty much for the rest of the year. We've heard Jerome Powell say this unlikely we're going to get any cuts this year. But again, if inflation continues to tumble, we're going to put Jerome Powell in a position where maybe he only does 125 basis point rate hike and then he's forced to pause. If inflation comes in shockingly low, like 5.7, 5.6, can you imagine? That's opium. But if it does come in at those levels, then we may even force the Fed to do an immediate pause. So that's the options we're playing with, all to play for tomorrow. Let me know how are you playing CPI, whether you're trading it, whether you're looking to buy the dip, if there's any opportunities, if you're taking a straddle or if you're taking a long position, let me know. Don't forget to check out the TA course, ijaz.uk/TA. Thanks for watching, and I'll see you in the next one.